Stocks rally into quarter end as large buying is expected from pension funds. Yields reprice lower as inflation expectations and commodities take a pause. Credit markets don't join the rally, suggesting this is just another bear market bounce. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 28th of June, and let's have a look at these markets. Right, so stocks had a decent rebound. As we had suspected, with June OPEX out the way, we thought there was going to be a bit of support coming from quarter-end rebalancing flows, and the market does tend to front-run these a bit. So that was our kind of reason for, either taking off some shorts or putting some tactical longs on. We still got some, hedges in the book. For when the world falls apart, but generally, lightening up on some hedges or putting on some tactical longs made a bit of sense, right? And we started to see that move, and obviously we saw the move accelerate on Friday. And partly because we've got this kind of shift in narrative going on with weaker commodities, potentially lower inflation expectations. That's kind of been the thing that's been touted as the reason for this sort of bullishness. Personally, I think it's more to do with, quarter-end flows being front-run, but, people like to put a spin and a narrative on things. In terms of yields, obviously they were lower, and that was led by actually Australia and New Zealand. US 10-year also retraced, kind of tagged that 3% level, has bounced off there, but, coming down from those highs of 3.5%. Looking at the kind of sigma adjusted moves, obviously, 2.5% moves, things like Alphabet, S&P, NASDAQ, Microsoft, etc. So a good rebound there. If you look at the dollar, that was pretty stable because you had kind of Powell and Bullard optimistic about the US economy. That was kind of counteracting the kind of less hawkish rate expectations, right? So net dollar didn't really go anywhere. Commodities obviously took a bit of a whack. Metals and ags down about 2 standard deviations. You can see the yellow bars down there. Energy fared better, but still showing signs of weakness as momentum's kind of fading there, basically. And finally, crypto saw some stabilization as the dust settles, around the 3 arrows default, and kind of who's left holding the bag there, basically. It couldn't really participate in the rally alongside the NASDAQ. But we'll talk more about that when we get onto the crypto insight section. So what else have we been looking at? So as I mentioned, the 5-year to 10-year inflation expectations number from the University of Michigan, that's kind of being touted as your main sort of reason why we kind of had that acceleration on Friday. Let me here, that came in at 3.1. The market had kind of panicked on that, or the Powell had panicked on that, basically, which is why they did the 75 bip hike. That was certainly what they were thinking. So that kind of getting reversed a little bit. People, thinking they're not going to be quite as hawkish if those expectations come back down. But if you look at the mean of that expectation, it's still at 4%. As opposed to the median, and that's still at like 2008 highs, right? So I don't really see that as a game-changing data point, and I think we need more confirming data points to ease the inflation fears, to be honest. Yeah, I mean, obviously commodities coming down a bit, which are obviously a leading indicator there. So that's probably more of a driver. Now, obviously, I've already said, I think the larger impact was the front running of, some people have been throwing around $100 billion of buying to be done in the week leading up to quarter end. So it's pretty decent buying flows. So that's what was anticipated. Also, if you look at the seasonals, so the chart on the top right, the seasonals for July heading into the 4th of July weekend are pretty good generally. So you can see the market does tend to have pretty decent performance in that lead up to the end of June and early July. So we were coming from pretty beaten up, pretty oversold levels, right? So that on top of seasonals, on top of buying flows, has kind of led to this sort of dynamic in the market, right? And then let's not forget that, University of Michigan the actual consumer sentiment number is at all-time lows, right? And that's the chart on the bottom, which kind of has the consumer sentiment number, and superimposed on top is the unemployment rate. And it's pretty rare, you know, for these things to diverge so badly, right? For unemployment rate to be low, that's on an inverted scale, and for confidence to be so low, right? And typically when that's happened, if we look back at history, it tends to be in these inflationary periods, right? And then what's ended up happening is that the unemployment rate has then gone up to catch up to that weak confidence because people kind of saw it coming, basically, right? So that's what we're looking at. If we are heading into a recession, which is what a lot of signals are pointing to, we're expecting that unemployment rate to catch up on that way towards, you know, where consumer sentiment is, basically, right? So that's the kind of way things are likely to be heading. So we obviously had suggested a long on the S&P, leaning on that 3,600 area as a stop, thinking that the amount of gamma the street would be long there would make it hard to break down that level, and targeting something like 3,900, right? That was kind of what we were saying when we were about 3,700. So that's worked out pretty well. But obviously now that strike is just not meaningful to really provide you any kind of support, right, when we're up here. So this has worked. This has worked. So now 3,800, if you look at the chart, we've got this kind of trend line here and intersection with some horizontal levels as well. So 3,800 should probably provide a bit of support. And I've been just trailing my stops higher, basically, on any longs that I bought, right? That's the way to play this, right? So if you had stops at 3,600, now you have them at 3,800, basically, right? So as a minimum, if you want to bring them up even more, then you're more than justified to, because, you know, we are 100 points away from that still, right? In terms of the upside, you know, the resistance levels that I'm looking at are kind of 4,000 and 40.75. That's where I'd probably really get excited about putting on some shorts again. But it's timing, right? Like, if the market hasn't managed to really rally between now and quarter end, like the end of this week, I'll probably still be adding to some shorts, right? Or I'll be more, you know, thinking about certainly taking off longs, because the reason to be long has kind of gone away, right? So that's kind of how I think about it. The type of trades I'll be looking to re-enter would be August and September expiries. A potential trade I'm thinking about is selling August calls to finance September puts. And not doing a put spread collar this time, but just doing an outright risk reversal where you own the slightly longer dated put and you sell the shorter dated call. Why would I look at that? Because SKEW's flattened quite a lot. We'll talk a bit more about SKEW in a minute. I just think the market might be underpricing, you know, the risk of a real sharp risk off into late summer if the growth data and the earnings do start to collapse, basically, right? We saw that, right? We saw when you do get the earnings disappointments, we saw what happened to the likes of Target and Walmart, right? So if we start to see more and more of that across the whole space in different sectors, then it could be another shit show for earnings season, basically, right? And that's why owning stuff out to September on the downside gives you plenty of time for that move to play out, basically. Being in SKEW. So JP Morgan derivative strategy have kind of put out a few charts here. And they're talking about the poor performance of SKEW. And, you know, the chart that they've got is a pretty, you know, basic 91.10 in 3 months and 91.10 in 1 year, right? I mean, that is the most simplest non-sort of technical way of looking at SKEW. And it can often not be the greatest way of measuring it and thinking about it, because they're, you know, depending on that, it doesn't adjust for the level of vol and things like that, right? But the idea is that if you do just look at that number and see what range that trades in, it's kind of at 3-year lows. So it's got beaten up, right? Pretty badly, right? The SKEW, it's kind of at 3-year lows. Now the same cannot be said for convexity. So what do I mean by convexity? So SKEW is the difference between downside puts and upside calls. It's the implied vol differential between that, okay? Convexity is the wings of the surface, okay? And one measure of measuring convexity is the difference between variance swaps and at the money vol, okay? Because variance swaps contain this convexity, right? They keep their vega wherever the market goes. The market can go down 80% and they'll still have loads of vega on them, whereas all the options vega would have disappeared, okay? So that's how people keep an eye on convexity and measure convexity, and think of it as a measure of tail risk, right? The spread between those two things. So if you see here, going back to 2014, that spread between 1 year variance and 1 year implied vol at the money forward vol was kind of in a range between, let's say, 2 and 4. Okay, maybe at a push 5, 2 and 5. That post the Corona crash exploded to more like 8, and now it's been in a range of like 5 to 8, basically. Okay, so that's still pretty elevated relative to what's happened to SKEW, because SKEW blew out in 2020 up to like 15, 16, but now it's got crushed all the way back to kind of 8, right? It's halved from those highs, whereas convexity hasn't budged at all, basically, right? So it's saying that market participants, and the reason is because since that blow up in 2020, a lot of people who were sellers of variants who would supply convexity to the street got blown to smithereens and haven't come back, right? Or if they have come back, they come back in smaller size and they haven't got as big AUMs, basically, right? So there's less supply of that convexity hitting the street. And then also just a realization from market participants that the fat tails still exist, right? There's still pretty wild outcomes that can happen from an economic perspective. So you don't want to be caught short tails. So banks' desks are just not willing to just come and sell that expensive convexity back down to those cheap levels that it was trading at. So they're happy to just kind of stay away from it and leave it at these elevated levels. There's no natural seller coming to sell it back down, basically. Okay. If you then look at the bottom two charts, it kind of shows you that, as obviously, and we've talked about this in our skew scatter graphs that we've shown you, as markets have traded down over the last few months, we've seen at the money vol almost float, right? So it's kind of stayed in the mid 20s. So we had the white line was what it looked like 2 months ago. And then as we traded down to like 4,200, the vol was predicted to be 25. But then as we kept going, the vol just stayed there, right? So even down at 37.50, the at the money vol stayed at around 25. It didn't ride up to like 30 plus, basically. Okay. So the vols just performed very badly. But then even when the market bounces a few hundred points, the vol kind of isn't getting as crushed as quickly, right? So that 25 level of at the money vol has been a bit more stable. Like, and we've looked at the VIX, we said the VIX has probably kind of found a bit of a floor in those mid to low 20 area. Again, it's because the market rallies are quite sharp, right? The short squeezes, the realized vol on the upside is pretty high as well. Right, so that's the new sort of dynamic that we're in, and it kind of explains why skew has not worked very well to the downside, but also is flattening. Right, so you can see whereas upside calls were trading at 15 on the white line, now on the current line, which is the blue line, those upside calls are trading closer to 20 because people value that those upside calls can still provide you some movement, basically. Right, if we go up there. Right, so that's kind of, and then finally, market positioning has helped because you've had de-risking from institutions, which have meant they've needed to buy puts less than before, potentially, right? If they don't own the market as much, they're not going to need to buy as many puts, right? And as I've said, put spreads have probably been a favored way to buy protection if you have bought protection, and that makes dealers less short the downside, therefore less need to go and reach for skew because they're getting given the skew, especially as the market drifts lower into past that front strike of that put spread, like we've seen with the JP Morgan trade, yeah? Rates, we mentioned lower yields, right? So a major stabilizing factor for risk markets last week has been this pullback in yields, right? As commodity prices and inflation expectations have come lower on the back of a weaker growth outlook, okay? The terminal Fed funds rate is now priced at around 3.6%, down from 4%. And the peak in rates has been brought a bit forward to around March next year, from maybe middle of next year, okay? And the market has taken that positively, okay? Euro dollar futures are now pricing in, about 2 rate hikes, rate cuts between DEC 22 and 23 contracts. So, that's telling you that they're basically rates are going to peak and then start to get cut again. That's what they're pricing. The 10-year found some support in its uptrend at around 3%. But, the jury's still out on whether rates have peaked or not, right? Some much smarter people than me think rates have got a hell of a long way still to go higher on the back of QT and things like that. And don't think 3.5% was the top in yields. But then you've got a bunch of other guys who are saying, yes, that's the top in yields, right? So anyone's guess who's right. Now, better durable goods orders yesterday, better pending home sales, and a bit of a ropey kind of 2- and 5-year auction in treasuries are things that could make yields go higher. And we've seen a little bit of a bounce in yields, right? But then, like I say, the Dallas Fed manufacturing print was a miss, a pretty bad miss, right? So if that gets confirmed on Friday's ISM, then that counteracts it the other way and probably is a force to bring yields back down. Okay, so just could go in either way, I would say, on rates. It's really not clear at all yet, I don't think. A few people have started to buy bonds, like Macro Alf. He said he bought his first clip of TLTs. I think Darius has even started dipping his toes back into bonds, but not in a massive size. So a lot of guys are just waiting to pull the trigger on the bond purchase. But I think they kind of really want to see confirmation that yields have peaked, and we're not quite there yet, it seems. Yeah, there's a lot of reasons to be long-term bullish, right? You've got a supportive factor for crude prices over the long term is that the Biden administration's policy of running down the SPR to levels not seen since the 80s, right? At some point, they're going to have to replenish that, and they're going to run out of SPR reserves, right? They can't just keep supplying like 1 million barrels. I think it's something stupid like 1 million barrels a day that they're supplying, right? I'm not, don't quote me on that, but it's a big number, right? It's the kind of number that is, a healthy producer kind of number that's coming out of them. And then, whilst the West kind of claims that Russian sanctions should be crippling the Russian economy, that's the reason for them. The evidence shows that Russia's been able to divert exports to other countries, such as India and China. They're still, pumping gas to Europe, right? And they're demanding rubles for their energy, right? So, that's why the ruble strengthening. They kind of hold the cards right now, and then at the same time, you've got a shortage of refining capacity in the US due to anti-fossil fuel policies, right? Due to the whole ESG movement. And that's led to a massive underinvestment in the US. And that's left this spread between refined products and crude at multi-year highs. So you got the chart there showing jet fuel, diesel, gasoline, massively higher than crude. That's that arrow showing the big spread between the refined products and the crude is because of this fuck up in policy in the US, basically, right? So, Western consumers are just taking it on the chin because they don't use crude, right? They use the refined products. That's what they use to travel, right? Any transportation they use requires those refined products. And that's a large part of the inflation problem that has been created by the West, right? And then lastly, throw into the mix the latest headlines from the UAE that they're producing very close to capacity, and the Saudis have got limited bandwidth to increase, even as Biden's going to go over there with his begging bowl, right? You've got an OPEC meeting this week. I mean, it just doesn't look great, right? The long-term prospects for any real increase in supply just aren't there. So your only hope of getting oil down is a horrible recession, right? Which I don't think anyone really wants, right? So we'll see what happens. But there is a chance that, we get a recession, but this stuff stays bid, right? And that's kind of the worst of both worlds, right? So one way to kind of protect your portfolio may well be to own some of that energy sector, just in case that scenario doesn't play out, basically. And then, looking at the metals, copper gold ratio is kind of dumped. That's the blue line. And the other line, the red line here, is the 10-year US yield. So the copper gold ratio is often touted as a leading indicator of where the 10-year yield has to go because it tells you about growth, right? So obviously we flagged what happened with copper breaking down. It has bounced a bit since then. The copper gold ratio is broken down. It often does kind of, I don't think these things necessarily need to catch up with each other super, super fast. But if the copper gold ratio keeps tanking, it kind of confirms where we're heading in terms of global recession, and the US 10-year would have likely topped out at 3.5, right? So it's unlikely that it's not going to get dragged down with it, basically, right? So something to keep an eye on, this copper gold ratio as a bit of a tell for where global growth is headed, and that may make it hard for 10-year yields to go much higher. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.